Good afternoon, everybody. Thank you very much for joining us. We're going to get started. For those of you that are not familiar with the Chamber, my name is Lauriane. I'm the head of events at the Chamber, and I'm very happy to welcome you for our first webinar of 2021. And what better topics to start with than the long-standing Brexit and COVID-19, of course. So today we're delighted to bring you a webinar in partnership with BDO, a long-standing patron member of the Chamber. They've put together a great panel of experts for us who are going to talk about maintaining your supply chain in the current context with all the Brexit and COVID changes. So a big thank you for BDO for organizing this with us, and especially to Hervé Mottet and Carole de Quatremas who coordinated this. Just in terms of housekeeping, as usual, we'll have time to take your questions at the end of the meeting. So please send any question you have through the Q&A box, which is at the bottom of your screen. And then at the end, we'll take the time to answer as many of these questions as possible. So without further ado, I'm going to hand over to Julia, who's going to introduce the team. Thank you.
Super. Thanks very much indeed. And good afternoon, good morning, everybody. And first of all, a big thank you to the French Chamber for inviting us to speak today. And if we go to our first slide, Leila, I'm extremely pleased that I have got a good panel of experts today. So our focus is going to be, and the timing could not have been better, it's going to be on the myriad of tax challenges that international groups are currently facing, with a particular focus on their supply chain. And obviously the two big things out there at the moment that people are having to deal with through their supply chain are in the area of COVID-19 and of course Brexit. So the way we thought we would do this today is I'm joined by colleagues both from BDO France and BDO UK. Håkan and Martine, who are from BDO London when we were in our offices, they're going to start with the indirect tax opportunities and challenges that we're seeing for the supply chain. And inevitably, I think Brexit is probably top of everybody's list at the moment post the transition period. I'm then going to talk a bit about some of the corporate transfer pricing aspects of some of the supply chain changes that we're seeing. And I'm going to invite my colleague, Sasha Boxenbaum from BDO France to chip in there. And then I think we're going to end up with perhaps a more forward-looking note as we look at some of the business change we're expecting to see coming in the next 12 to 24 months, some of the innovation. Sasha and Hervé Mottet, Hervé from our innovation tax team, are going to talk about some of the opportunities there for businesses. And as already said, we'll take questions at the end. I'll be keeping an eye on the Q&A box and I'll try and allocate them once we get to the end. So please do take advantage of that. So I think that's probably as much as I want to say at this point, and I will pass straight over to Håkan and to Martine, who are going to talk about some of the key and VAT and customs implications.
Thank you very much, Julia. So Martine and I, we are part of a rather large team in the UK. We support and assist our clients with any indirect tax matters. So that in our terminology, that means VAT and customs. We also work very closely with our colleagues in the other BDO offices around the world, and not least, of course, BDO France, where David Hirsch is a person that we know very well, Martine and I, and work close with on many projects. So I will first start talking about, just give a bit of an overview and talk about where we are. So my slides talking about customs is going to be very much Brexit focus. So just as an introduction, as you all know, UK has left the EU and the transition period ended 31st of December. So we're now in the post-Brexit period, and that means quite a lot of changes for UK companies and for any companies that deal with the UK. So just on a very high level, and we will get into each of these points in more detail, Martine and I, but on a high level, the new conditions apply from 1st of January. The new condition mean that there are no more intra-EU movements between the EU and the UK. So instead we talk about proper imports and exports. That means that customs declarations will be required for goods moving between UK and the EU, and import VAT will apply for goods coming into the UK. Martin will talk a lot more about that, so I won't say anything more at this point. Customs duties and unrecoverable costs, they will apply. There will be exceptions, and of course we have the free trade agreement, or the trade agreement, I should say, between UK and EU that has come in force as per the 1st of January. And the UK, of course, have other trade arrangements with other third countries, which will be relevant for goods coming into the UK or leaving the UK heading for those countries. So if I, thank you very much, talk first about the direction from the EU to the UK. So we talk about goods that move, say, from France to the UK. What will change, or what has changed now? Again, we talk about a third country supply from an EU perspective. So goods are exported from the EU and they need to be imported into the UK. And a question that we often get is, well, who's responsible for that export and that import? Who makes the declaration? Who should pay for the customs duties and import VAT if that apply? And the answer to that is it depends, and it depends on the Incoterms. So Incoterms has traditionally, the trade between the EU and France, for example, has of course not been applicable to the questions about exports and imports. Yes, Incoterms have been relevant in terms of who should pay for the transport and who bears the risk of the goods being damaged or lost. But the question about who makes export and import declarations is often not at all mentioned in the contracts between business partners in the EU and the UK. So Incoterms is really important and something that may not be already agreed between the parties, something to keep an eye on. If we look at customs authorizations, because the UK has left the EU, then the authorizations that HMRC have issued may or may not be valid. So, and likewise, an authorization issued by the French authorities also may no longer be valid. So that's really important to keep in mind, that with the new UK customs regulations, the new UK customs tariffs, etc., it really means that we're starting from scratch in terms of the authorizations. Now, obviously, if you're a French business and you got an authorization from the French authorities, then that will not change. Same thing if you're a UK business having an authorization from HMRC, that will also not change. But there will be many situations where there's a mismatch there about the establishment and what authorized competent authority have issued that authorization or certification. So for example, we mentioned the binding tariff rulings. There will be different ones for the UK going forward. The ones issued by the EU will not be binding on a UK import and vice versa. And then I just want to spend a little bit of time talking about EORI numbers. That's also something that we often get a question about. Do you, as a French exporter importing into the UK, can you just use your French EORI number or any other EORI number issued by an EU competent authority? And the answer is yes for your export, but not for the import into the UK. So if you, a French company, is the importer in UK and you're not established there, you need to get a GB EORI number in order to make that import declaration. And if you're not established in the UK, the GB EORI number is not enough. You also need to have an indirect representative who is established in the UK and who is agreeing to be jointly and severally liable for the customs debt. So with that, I'm going to hand over to Martin to talk about, from a VAT point of view, when you have supplies from the EU to the UK, what to keep in mind.
Perfect, thanks Håkan. So from a VAT perspective, obviously we can no longer rely on those cross-border rules, and we can no longer bring the goods into the UK from the European Union on an acquisition VAT basis. So the export from the European Union would in theory be zero rated from France, but the import into the UK would typically attract customs duty, unless the zero tariff can be applied under the new trade deal, and import VAT as well. So previously we could put that onto the VAT return as an acquisition into the UK. It would flow through onto the UK VAT return. It's quite lucky. So the UK has now introduced postponed import VAT accounting. So like the old rules of acquisition VAT, where you can pop the local tax onto the UK VAT return, the importer, so whoever's responsible for importing those goods into the UK, can now apply for postponed import VAT accounting, which basically allows any import VAT, which would be due when the goods arrive at the border in the UK, to be applied onto the UK VAT return instead of having to pay that in advance. So that's a good simplification that many member states have at the moment, but the UK never had previously. And the whole aim is to try and simplify the process for import with regard to UK VAT registered businesses. So in the UK, whoever is the importer would need to declare the goods. They would need to pay or put the postponed import VAT accounting through their VAT return, and then typically would need to make an onward taxable supply in the UK for VAT purposes. So it's really, really important, and like Håkan said, to really understand who is responsible for the export of the goods out of the European Union, and actually who is responsible for the importation of those goods into the UK. So in theory, it could be your UK customer, it could be you as a French business, or an indirect representative like a freight company who would clear those goods into the UK. But in the example whereby you might be responsible for the importation of the goods, or you use an indirect representative like a freight company to import the goods under their local EORI number, in both of those cases, if you're a non-established business, you probably would need a UK VAT registration too, and you would need to make an onward domestic supply of the goods. So a couple of other things to remember about bringing goods into the UK. So obviously those simplifications on the movement of goods will no longer apply. So we used to have some rules around, and you still do in the EU, around holding stock for call off, or being able to move goods between 3 different businesses in 3 different countries and not having to have a requirement to register for that under the triangulation rules. All of those rules now have gone from a UK VAT perspective. So, you know, we no longer are part of the European Union, and as such, typically if you hold goods for call off in the UK, that in itself can now lead to a UK VAT registration requirement and an onward domestic supply being made. We're also seeing some changes with regard to distance selling. So when you sell, if you were to sell into UK to private individuals, you used to be able to rely on the European rules, which allowed you to account for VAT, say in France, until the relevant distance selling threshold in the UK has been breached. Again, we can no longer rely on those distance selling rules. However, we do know that there will be changes to the European rules come July this year, which will enable slight simplification on non-established shipments to and from the UK. Next slide, please. So I'm going to hand back to Håkan, who will talk about supplies from the UK to the EU, so coming out of the UK.
Thanks, Martin. So yes, now we turn the perspective and looking at from an outbound UK point of view. Some things are similar in the sense that, again, this is now an export followed by an import. And keep in mind that, of course, for every movement, either from the EU to UK, or as here from the UK to the EU, for each of those movements, there will need to be 2 declarations, an export and an import declaration. And again, as before, who is responsible for that depends on the Incoterms. So similarly, when you're moving goods from the UK to the EU, you need to keep in mind on who is going to be the importer, who can be the importer. So in that sense, if you're a UK company and you have customers in the EU, then of course, from a UK point of view, it's ideal if the EU customer is going to be the importer in the EU, because they are already established there. But sometimes that may not be commercially possible. So the UK exporter will take on the role as importer in the EU in addition. And same way here, if you're a UK company, you're not established in the EU, then you're going to have an indirect representative in the EU who is going to be jointly and severally liable for the customs debts. So the UK company will need to have an EU EORI number in addition to their GB EORI number, but also an indirect representative. And this is a really tricky bit because we know that historically, not all member states have been enforcing this diligently or consistently over time and consistently over different industries and types of importers. So there's some level of confusion around what is going to be required. But if we look at what does the law say, then the EU customs law, the Union Customs Code, is absolutely clear about that. You need to be either established in the EU or you need to have an indirect representative who is established in order to import goods in the EU. So then, talking about the origin of goods, that has always been important because that is a mandatory field on the customs declaration. But of course, now when we talk about the movement of goods from the UK to EU, it would be natural to assume that you can use the trade agreements and get the preferential zero duty rates for the goods that you are shipping from the UK to the EU. But keep in mind that just because you are shipping it from the UK doesn't mean that it's automatically going to be a country of origin UK. So country of origin rules are very complex. And we've seen in the EU-UK agreement, they are, if anything, more complex than in many other trade agreements. And that leads to that last bullet point on my slide there about re-importation of goods. So here is something that we've seen a lot of confusion about and questions about in these first couple of weeks of the year. So the way that the EU-UK trade agreement works is that if we think of a UK trader, if they bring goods in from the EU in the first place, maybe the goods have been manufactured in an EU member state, the goods are then being brought into the UK. The UK importer can claim the preferential duty rates if the goods are produced, originating in the EU. So that's good. But if then the UK company wants to sell some of those EU produced goods back to the EU, then you're not automatically covered by the free trade agreement. So even though those goods are EU originated, they have no right to be claiming their preferences. And that's going to be a tricky situation for many UK companies that say import goods from the European continental Europe, and then send some of that over to the Republic of Ireland. So then you have goods moving from EU to UK back to the EU, where only on the first leg, that company will be able to benefit from the free trade agreement.
We've seen a lot of confusion around this, haven't we, Håkan? So a lot of the conversations we've had since the 1st of January have been around, isn't it great news that Boris has been able to broker this deal? And then you have to step back and you have to have the conversation on origin and what does it really mean? The fact that you might manufacture your fruit juice in Europe doesn't mean that the origin of the fruit itself is European. So I think one thing that we've been trying to very clearly explain the messaging over is that origin is really key. And if you're not comfortable on your origin, you probably need to take some advice, because if you get it wrong, you won't necessarily be able to apply the zero duty position that's been communicated by some of the politicians.
That's right, absolutely, Martin. And here the question of processing also is really important, because what is processing? Is repacking and relabeling, is that amounting to processing, or is that just not enough handling for qualifying? Will it change the country of origin if you do some minimal processing in the UK for these goods coming from the EU and then being re-exported to the EU? So there's absolutely a good reason to look at every situation on a case-by-case basis and see what happens to the goods once they arrive in the UK. Are they just stored? Is there some kind of processing? And if there is processing, what exactly is done? Is it sufficient for changing the country of origin from EU to the UK? If so, what happens then with the preferential treatment going forward? And that's the country of origin rules are always complex. We see that with any other free trade agreement that the EU or the UK have with third country. The country of origin rules are always specific to the trade agreements. They are never exactly the same between two different trade agreements. And the country of origin rules even differ from one product to another within one trade agreement. So you can have a tolerance for how much of the value can come from a third country. And that tolerance will be different from one product to another. It could be that a good will have perhaps 40% of non-originating content, value content, and still qualify for the trade agreement. So really complicated. And I think our advice there is not take anything for granted, but really think this through. We're going to come to a slide later where we talk about what to do next. So we'll come back to that point. And I think if you go on to the next slide, please. Yes, these are topics that are not specific to Brexit, but I think it's fair to say that Brexit has highlighted the importance of getting these things right. So when we talk about the customs value, what to declare on the import declaration and what to declare on the export declaration, that has got an extra importance because of Brexit. There's simply more declarations that companies will need to make. So if you had a company that only dealt EU, UK before, that never had to really deal too much with the nitty-gritty details of the customs valuation and the customs classification or the origin of products. So these things have always been important for any imports into the UK. But of course, now they're also applicable to imports from the EU. And there are a number of simplifications and different reliefs that UK importers can claim. These reliefs exist also in the EU customs law, and the UK customs law have more or less copied and pasted these reliefs into the UK law. So most of these reliefs work in the same way, but there are some nuances. So again, we mustn't take for granted that what was valid in the EU customs law is going to be exactly the same in UK customs law. But the reliefs themselves, customs warehousing, inward processing, return goods relief, etc., they apply in the UK too. So if you move goods in the scenario I talked about earlier, say from France into the UK and then onwards from the UK to Ireland for a proportion of those goods, then a UK customs warehouse might be a way to mitigate additional duty costs. Likewise, inward processing, if instead of storing, you do processing in the UK. And again, the country of origin is important. Naturally, if you bring something into the UK that has EU origin, then you may not have that many benefits of a customs warehouse inward processing, but chances are that some of the products that the UK company is sourcing from French suppliers may not be EU country of origin. And again, then a customs warehouse would fill then a role in minimizing the customs duties payable. Transit is another relief that is going to be very important. If you're moving goods from France, say to Republic of Ireland, through the UK without really stopping, without being stocked anywhere, then transit could be a way to avoid having to make the UK declarations and possibly paying UK duty. We talked about customs representative. It's really important. Some freight forwarders are willing to make the declaration on your behalf, so they would act as a direct representative from a customs point of view. But if they're not taking responsibility, then the responsibility remains entirely with the importer, exporter. So the customs representation, again, is really important to be aware of. The freight agent or the customs broker, if they are acting as indirect or direct representative, makes a big difference, and you need to be clear with them about that. And finally, Aeo certification. EU has its own Aeo scheme, and UK per 1st of January now has an equivalent UK Aeo scheme. It goes under the same name, but it's a different logo, and there is a mutual recognition agreement between UK and EU. So if you are a UK Aeo certified trader, you will get the same beneficial treatment in the EU customs and vice versa. So that's great news for everybody who has already acquired an Aeo certification, and good news for the traders that are thinking of having one going forward. And of course, Aeo is not going to do anything about the duties you're paying, but Aeo is a way to reduce the risk for delays in the supply chain, which we all think is going to be even more important going forward between the EU and the UK ports and airports. So I'll hand back again to Martin to talk about that side.
Thanks. Thank you. So for VAT purposes, it's completely the other way round to what I talked about previously. So if we're moving goods from the UK to the EU, now we can no longer apply the intra-EU acquisition rules. We're going to have an export from the UK and an import into Europe. What does that mean for VAT purposes? So whoever is the exporter, typically be a zero-rated export from the UK. Like Håkan said, in order to export out the UK, you need a UK EORI number, which is your customs number to quote for the export. The question that we keep having lots of conversations about in the last month or so is just regarding who will be the importer of those goods into Europe. Because the importer, like I said previously, is responsible for clearing the goods in the relevant member state, and is responsible for the customs duty and the import VAT in the country in which the goods are going to be imported. I think Håkan mentioned it earlier. Whoever is the importer needs to have an EORI number in the European Union. And if that's a UK company, we're finding that the UK company may have to be established in a member state in order to obtain a European EORI. Once we've got the goods cross-border, we would have to pay the import VAT, and that is recoverable on a local domestic VAT return, because if you are the one responsible for importing the goods into the EU, into that member state, you'll also make an onward domestic supply, which means a local registration requirement for VAT purposes. Also, depending upon the member state, we may also have a requirement to have a fiscal rep locally to support that registration piece. So ideally, the import VAT shouldn't be a cost to the business, but the increased burden with local registration requirements in all of the countries in which you will be importing has made some of our clients think about splitting out their supply chain from a UK to European supply chain, maybe having a hub to import all of the goods into one country and then disperse under the kind of the EU acquisition dispatch rules So there's things that we can think about when we're moving goods into Europe post-Brexit in order to mitigate the requirement to do lots of paperwork from a wider VAT perspective. Again, some of the simplifications that our UK businesses may have been using before across Europe will no longer apply. And again, if we're shipping a bit on a business to consumer basis into Europe from the UK, we can no longer apply the distance sales regime. So that's actually quite interesting. So some of our UK retailers have taken the position either to have a European hub and distance sell, say from the Netherlands into European private individuals, or in some cases, actually, some of our UK retailers have decided not to sell on a distance sales basis into Europe until the rules change in July. So lots to think about with regard to goods going forward. Next slide, please. So whilst we talk quite a lot about goods and Brexit has been mainly focused around goods, there are some changes for services that we shouldn't forget. There's a few, but the key ones are set out on the slide. So things to watch out for. So typically, if you supply services on a business to consumer basis and they fall into kind of the general rule for services, we used to have a position whereby UK VAT would be due on all types of consultancy advisory services supplied to private individuals in the UK and in Europe. Now, what the UK has done is they've removed the word EU from a lot of their legislation and they've swapped it with UK. So from a UK perspective, we've now got the position for those type of generic services supplied on a business to consumer basis that UK VAT would only be due where the recipient, the private individual, is based in the UK. So for example, if you were to provide legal services from a UK law firm out to a private individual in France, typically from a UK perspective, there would be no UK VAT on that supply. So quite interesting. There could be French requirements that would kick in post-Brexit, but yeah, it's definitely something to watch out for if you were a UK business supplying into Europe on that basis. The other thing that we've seen is just around use and enjoyment. So we've got some special rules in the UK on a business-to-business basis for supplies such as telecoms, electronically supplied services, which basically looks at place of supply for VAT purposes, a place where VAT is due, being the country in which the recipient of the service belongs. We've got an override in respect of certain types of services that if the services, for example, were used and enjoyed in the UK, but you were invoicing and the recipient was a US business previously, there could be UK VAT due on those type of charges. Because of the change from EU to UK in the UK VAT legislation, we're now potentially looking at use and enjoyment on a UK basis in respect to supplies being provided to European businesses. So that's quite an interesting one to watch out for as well. On the MOS scheme, so mini one-stop shop for business to consumer supplies of types of services that would fall into that category. Obviously, we can no longer use the union scheme, which is applicable to European businesses, but there is the non-union scheme that can apply. In theory, a re-registration requirement there. So all I'd say on services is that, yes, there are some changes. Brexit is not impacting them as much, mainly in the UK VAT legislation where we would have a UK and an EU rule. As I say, the UK has squashed that to make it only really applicable, the UK law that is only applicable to UK businesses. So we could be seeing lots of requirements for some of our UK clients, for example, to have a requirement to register for VAT in Europe in respect to some of these types of services, and vice versa, there may become requirements to register for VAT in the UK going forward. Right, so that is a very, very whistle-stop tour of VAT and customs duty in respect of Brexit. We could talk for days, but we won't. I will now pass you on to Julia, who will talk you through some of the corporation tax issues to think about.
Great, thank you, Martine. Thank you, Håkan. So moving on now to talk about some of the corporate tax and transfer pricing aspects that we're seeing. And actually the key challenge for me and my colleagues is the amount of change that we are seeing in international supply chains. And particularly as that change is very much driven by the business or indirect tax and customs, it's very important to remind teams out there that where there is change to international supply chain, really people need to think on a wide business basis with other support services to make sure that areas such as corporate tax and transfer pricing is being picked up. So if we start at the box in the center, the biggest change that I'm seeing is groups are suddenly introducing new activities in different countries. And sometimes those are countries where they already have a presence, and sometimes that they are new countries where they haven't got an existing presence. And the range of activities varies hugely. I mean, we've just heard a lot about it might just be a need for a VAT registration. However, we're also seeing operations, so new companies, new businesses set up perhaps in Europe as well as in the UK. One of the biggest ones that I'm seeing is increased inventory holdings and warehousing activities. And I think we're seeing that two reasons. Partly it's been the challenges of C19. Sometimes it's just been the sheer challenge of moving stock around. Sometimes, particularly say in e-commerce, it's been the growth of that business and the need to have more localized stock holdings. But of course, Brexit as well has led to businesses often developing inventory holdings either side of the channel. Previously, there might have been a single European distribution centre. Now businesses are looking at having a distribution centre, UK, one on continental Europe as well. I think the point I want to make here is that it's always important to think of the implications of that new presence for corporate tax and transfer pricing purposes. Might it lead to a need to register a corporate tax presence, a branch, perhaps even think about a new subsidiary? If you're introducing new warehousing activities for a pre-existing subsidiary, do you need to think about changes to your existing transfer pricing and tax frameworks? And then just for anybody who's got a particular interest in international tax, just to remind them that we had some large changes by the OECD a few years ago. They introduced some changes to permanent establishments, one of which is called anti-fragmentation rules, which means now when you're looking at whether activities might just be preparatory and auxiliaries, you now need to look at all your activities in a territory rather than just the activities associated with a particular fixed establishment that you're worried about. Another example is the number of new corporate entities and new title flows that we're seeing. So some groups have previously sold to European customers direct from a UK entity. They might now be considering having a new European entity selling, or they might be considering using a pre-existing subsidiary to sell to that market. Another good example is Ireland. The Irish market has often been serviced from the UK business. And actually, I'm aware of a number of groups who are now saying, well, actually, should we have that Irish market serviced from one of our continental European business? Does that make more sense? And the point here that I want to make is, there are a host of corporate tax and transfer pricing issues around with new legal entities, but really have your eyes open for things that might be potential outbound transfers of value. And that's whether it's outbound transfers from continental Europe to the UK or vice versa. So for example, transferring the rights to an Irish market into group, or perhaps transfers of potentially valuable customers and contract relationships. And at this point, I just thought I would ask Sasha to see if my experience is consistent with what he's seeing from BDO France perspective.
Yes, thank you, Julia, and hello, everyone. And yeah, I completely agree with the concern we are seeing here in France from our clients. Well, our clients mainly have indirect tax and VAT concerns regarding Brexit. And it's true that for direct tax purposes, it has less consequences as for indirect tax consequences, notably, even if the EU directive, which reduces most withholding tax to nil, we still have a double tax treaty protections from France to the UK. So dividends, interest and royalties will not suffer withholding tax even after Brexit for most of it. We have an exception for shareholders that hold between 5% and 10% that were protected under the EU directive, that are not protected and that are not protected by the double tax treaties. But in most cases, we will not suffer any additional withholding tax on flows between France and the UK. But still, you have to look on a country by country basis, because I'm talking about the double tax treaty between France and the UK, but we have, of course, other double tax treaty that might not offer the same protections with other EU countries. So for direct tax purposes, it has not as much impact, as I said, as for VAT and indirect taxes. But still, as you said, we are seeing a lot related COVID-19 or Brexit value tax changes, which have substantial consequences in France in terms of permanent establishments, in terms of profit allocations, in terms of substance. And the French tax administration, as well as the French courts, are more and more aggressive on this subject. So I can only confirm what you just said, Julia, and we have the same concerns in France, and this has to be looked at very closely.
Thank you. And although the focus today has been very much on supply chain related to Brexit, I wanted just to mention to people that tax teams, tax advisors are looking at transfer pricing arrangements and whether transfer pricing policies today that have maybe been in existence for several years, are they fit for today's economic environment given the challenges of C19? There's new guidelines on this from the OECD that came out in December, but it does mean some groups are looking at changes to their intercompany pricing. Very, very important to think about this, not just from a corporate tax and transfer pricing perspective, but also to think about it from a VAT and customs perspective if you're looking at retrospective or prospective changes to intergroup pricing. And then the last area that I wanted to mention is looking forward, we're seeing huge amounts of innovation. We're seeing large amounts of business change, whether it's to how supply chains are working. E-commerce is a particular area where we're seeing groups make technical developments, also seeing groups change their ways of working, and change perhaps their product offering, their ways to market. Really important as you think about these strategies to always think about the corporate tax consequences as well. And that's to think about, well, how does it fit to my existing IP holding structuring? What might some of the risks around having new innovation in new territories be? And actually, more importantly, what might some of the opportunities be? So as you think about that strategy and you think about your forecasting, you're very much doing it on an after-tax basis. And with the focus on innovation, I'm going to hand over to Hervé, because one thing we're seeing groups very interested in at the moment, especially as many people are looking for cash, is in the area of innovation and R&D tax credits. So over to you, Hervé.
Thank you very much, Julia, and I completely agree with your comments. Effectively, we see a lot of our clients, especially when they have an international business where they have to actually innovate for various reasons. Sometimes it's to adapt to the COVID-19 environment and have to make everything digital. There's a big investment on IT for digital transformation. We see a lot of R&D investment on automating as well. And we see as well a lot of R&D regarding effectively the customer user's experience. Bearing this in mind, although you could have an innovation which is international, when you look at the support that governments can provide, you need to look at national support. And what Sasha and I are going to do today is just to give you a very small snapshot of what is available, at least in the UK and France, from a support to invest research, but also in terms of what are the support to generate IP and the use of that IP when commercializing it. So the first one, which is probably the biggest incentive, is effectively the R&D tax credit. There is an R&D tax credit regime in France and in the UK. So in the UK, it's a very generous regime, which is more generous for SMEs who are effectively less than 500 employee at group level perspective and a turnover of less than 100 million equivalent euro, or 86 million in gross assets in the balance sheet. So we see a benefit for an SME around roughly 30%. And even if you're in a loss-making position, you can still most of the time get some cash back. For large companies, there is a tax credit which is taxable at 13%, which is a net benefit around 10% or so. And it can be claimed up to 2 years after the end of the accounting period. Sasha, do you want to give probably really top level view in terms of the tax credit in France?
Yeah, sure, Hervé. And yeah, France has always been interested in attracting R&D talent and innovative companies. So we have also a very generous R&D credit, one of the best in the world, with a 30% credit on R&D eligible expenses, which can be for SMEs, give rise to an immediate refund, so a cash benefit, which is immediate, or you have to wait 3 years and use your tax credit on possible corporate income tax to be paid. So yeah, in France, it's a very interesting regime, and such regime is kept for now in France to attract talents around the world. So yeah, I think Hervé, we can move on to the patent box regime.
Thanks, Leila. So just really quickly on one of the schemes that have been very attractive for a lot of companies generating intellectual property is the patent or the IP box, which effectively reduce the amount of tax, corporation tax paid on profit deriving from the IP generated. So in the UK, the IP needs to be effectively reflected through a patent. And there are some, the patent needs to be filed in Europe, and there must be some development around that patent, and can be claimed up to 2 years after the end of the accounting period. Sasha, from your side, yep, on the IP box, what would you say is the main?
Yeah, we have a new patent box regime which is now two years old, but it's quite an interesting one as well, with a 10% CIT rate like in the UK. But we have a scope that is wider, because we can include notably software when we can prove that it is original software, and of course all other conditions that are now applicable in most OECD countries, such as the nexus ratio must be fulfilled, and strong documentation is needed. But yeah, France is trying to be attractive on this as well. One other point I wanted to make on the R&D credit and Brexit consequences is that you could have subcontractors that were approved by the government in the UK because it was in the European Economic Area before, and you could claim R&D credit on subcontractor in the UK, whereas now because of Brexit, it is not possible anymore. So this is one direct Brexit consequences on the R&D credit. So yeah, thank you, Hervé.
Okay. So Hervé, I think you're on mute, but I think you're trying to say that that's your section finished.
Absolutely.
Excellent. Okay, so that was a whistle-stop tour. We've left ourselves 10 minutes for questions, so well done, everybody. We've got 3 questions in on the Q&A, and we've got 1 question in on the chat. So let's start with the Q&A. So Håkon, do you want to deal with the first question on the rules of origin? Oh, have we lost Håkon?
You're on mute.
Oh, sorry, I'm on mute. Beginner mistake. So yeah, I'm happy to answer that. So the question there is about, can you get a binding origin ruling if you're unsure of the country of origin? And the answer is yes, both in the EU and in the UK. So in the UK from 1st of January, it is called an advance origin ruling, but it's the same really as a BOI, the binding origin information. So you would apply for it. You need to apply for it on a product by product basis. You need to apply for it before you import or export the goods. In the UK, you will simply do it online to HMRC. You should expect to get an answer probably within 1 or 2 months, though it can take longer. Hopefully that answered the question.
Thank you, Håkon. And the second question is, if I am not an importer, but I'm a hotel who's simply buying goods, guest toiletries, from a supplier based on the EU, and the supplier is delivering those goods to us, do I need to have an EORI number?
Right, so if the supplier is delivering on DDP terms, delivered duty paid to the UK, then it's the supplier who needs to do the import declaration and the supplier who needs to get a GB EORI number if they don't have it. So no, the UK hotel who is just getting the goods delivered, duty paid to them, does not need to have a GB EORI number. You only need to have a GB EORI number if you have to make an import declaration in the UK or an export declaration out of the UK.
The only thing I'd say there, Håkan, as an add-on to that point is the fact that once, say, an EU business, the supplier gets a UK EORI number and delivers those goods to you in the UK, delivery duty paid, they then will become liable to make an onward domestic sale in the UK of those goods to you. So charge you UK VAT. They will be the ones that will incur the customs duty if applicable and the import VAT when the goods come into the UK. So you might find it that the European supplier does not want to be the importer, and instead they push or they request that you become the importer of those goods into the UK, and the sale happens prior to the goods landing in the UK. If that's the case, then yes, you will need an EORI number in the UK. It's quite easy to get one. You fill out a form. If you're already VAT registered, it should already be linked to your UK VAT number. So HMRC should issue those within a matter of days. So it really depends. And it was on our what to do now slide that we canted over earlier. But one thing is really to understand the supply chain. Who is the exporter? Who is the importer? Because they're the ones that will be liable for the duty on the import piece.
Thanks, Martin. Yeah, good point.
Moving on, there's some quite specific questions here around very specific facts. So, but we'll take a couple more. And then what we might do, Håkan and Martin, is I do think your slide on what to do next is good. So that might be quite a good one to finish up on. So let's do a couple more questions and then we'll revert to that slide because I think it is helpful for people. So I think the next one, Martin, is probably for you. If you are a UK company and have an EU warehouse, can you ship products from the EU warehouse to another EU country and issue an invoice from the UK? How does this work for that?
I think it depends what the warehouse is. So is it a customs warehouse? So if there's no customs authorizations or anything in place and you have goods in one warehouse in the EU and you want to ship them to another EU warehouse and you own those goods at the time you move them, then in theory, if you are a UK business, in order for you to effectively move those goods from the EU country, you would need to have a local, if those goods are already cleared in the European Union, it's much more straightforward because then it would just be a own movement of goods from one EU country to the other EU country. You wouldn't necessarily have to raise an invoice to prove the movement of the goods, say from Germany to France, but there would be statistical reporting to go on to a French and German VAT return in theory, and it could lead to local VAT registrations as well. So you do need to watch out for where you own, or we often see this being the case if goods are put into an Amazon warehouse and goods are being moved between one European Amazon warehouse to another. So again, movement of goods, you need to track them. And that could come with a VAT implication with regard to registration and own movement of goods reporting. So yeah, it's a little bit more complex, that one.
And then we might just, there's one on the chat that came in quite early. So because I'm trying to do these in time order. Hi, we need to put the importer's name and full address on product labels. If we are VAT registered in France, have a French EORI number and sell to European customers DDP, including VAT, are we then considered as importer? I think that's one for you, Håkan, isn't it?
Yeah, so so the goods are moving from the EU to the EU, or they're moving from UK to the EU?
It seems to be France to Europe.
Okay.
So again, there's no customs declaration needed if it moves from one EU member state to another EU member state because it never leaves the EU customs territory. So then it becomes entirely a VAT matter, really. I'll hand over to Martin.
Thanks.
No, we've got...
So if you've got goods in France and you have a French VAT number and the goods are already cleared into Europe and you sell those goods from France to a customer in another member state, then in theory you can still apply the European simplifications if the goods are owned by the French legal entity that is VAT registered. So dispatch from France, acquisition into Germany. So nothing really has changed in that respect post-Brexit because the goods are already cleared within the European Union. It's just a question of who owns those goods at the time of the sale and whether that's the French VAT registration or not.
Okay. And then final question before we head back to the slide. I'm sorry, I know we're not going to address all the questions. And actually, I think this is very indicative of what we're seeing in these first few weeks as everybody is dealing with the post-transition period. And I think I know that Martin and Håkon are on the phone constantly at the moment trying to deal with these issues as they come up. But the last one, Martin, I think is for you. It's from Neil Wakeham. It's, we've transferred meat products from Poland to Ireland using a UK as the importer. Goods sent directly to Ireland. Goods have been charged with local Polish VAT at 5%.
Yeah, it's a question of, so when you think about goods and you think about where that's charged, you have to think about where the goods physically located when they are sold. So if you take, in theory, title to the goods when they're in Poland, say you take them from a Polish manufacturer and you physically own those goods in Poland and then you move them out of Poland, you will typically get charged Polish VAT because that sale takes place on a domestic Polish land basis. And then you would be responsible for exporting those goods out of the European Union or to Republic of Ireland within Europe. So the key point to work out the VAT treatment really is to understand the supply chain and to work out where those goods have been sold to you and where you take title to them. In some cases, you may not have needed to be charged Polish VAT, but it really depends upon the commercial terms in which you take title to those goods and then what you're going to do with those goods and who's responsible for the transfer of those goods to Ireland. So again, as Julia says, we're seeing loads of these questions at the moment, and unfortunately it's on a case-by-case basis and sometimes it's not straightforward. But if you take title to the goods when they're physically in Poland, then you own those goods in Poland. So you're always going to get charged local VAT unless you export, and you can provide proof for export, but that's a different conversation.
Thanks, Martin. Now, Leila, could you take us to slide 15 and we'll just let Håkon finish today off. I'll give you a couple of minutes just before we finish right at 2, just on our Brexit to-do list. Slide 15. That's it.
Great, thank you. Yeah, so this is a mixed bag of what to do, both from a VAT and customs perspective, but I'll just go through them very briefly. Martin, feel free to jump in when you want to. But the first step that Martin and I always stress is mapping the supply chain and distribution channels. So know exactly the goods that you are bringing into the country, where are they coming from? And as Martin said, from a VAT point of view, where is the ownership transferring of those goods? And then looking at the other ends, at outbound. So when you are selling these goods, where do they go to? Do they stay in the country? Do they go to an EU country? Do they go to a third country? And again, the ownership question. So mapping supply chain, really, really important. We help clients, all the time with that, and it's really important. And then check really that your business partners, whether it's your shippers, your transport companies, or your suppliers or your customers, that they understand what has changed since 1st of January. Who will be making the customs declarations? That's really important. Many companies in the UK have never had to deal with this before. I think the number that HMRC estimated, number of UK companies, not persons, but companies that have only traded with EU before, I think is something like 250,000. It could be more than 250,000, but it's a huge number of companies who have no experience of this. So getting in contact with a freight forwarder who can actually make the declaration, unless you decide to make the declaration yourself in-house. That's not, that's something that needs to be worked out. Do you need to have the VAT registrations, as Martin said? Can you benefit from the origin rules? And just very briefly on that, I saw a question popping up about, in that situation we talked about, we move goods from continental Europe to the UK and further on to Republic, is there any way you can benefit from trade agreement? And yes, if you do sufficient processing in the UK rather than just storing them, then it changes country of origin to UK, which makes them then, qualifying for the trade agreement preferential duty rates when it moves over from UK to Republic. Benefit from any reliefs, look at that, figure out, does any of these reliefs work for you? Some of them may, not all of them will, for everyone. And finally, do you need to get more knowledge in-house? And we can help with that too. I think that's it.
Brilliant, thank you. And I will hand back at this stage to the French Chamber, but thank you to all the presenters.
Thank you very much, everybody. There is not much left for me to say, apart from a big thank you to BDO and to our 5 speakers for all the great insights you've shared today. We'll be providing a recording of this webinar on the website within the next couple of days, and we'll also be sharing BDO's contact details in a thank you email. So please do feel free to get in touch if you have any further questions. Thank you all very much for joining us this afternoon. I hope we can see you again very soon. And in the meantime, I hope you have a great afternoon and rest of your day. Bye.